Hello and welcome to the IMF annual meetings in Washington, DC. I'm here with Christian Meissner, Global Head of Corporate and Investment Banking at Bank of America Merrill Lynch. Christian, thank you for joining me.
Nice to be here.
Thinking about the year ahead, there's a lot of speculation about US rate hikes and also what's going to happen in Europe in terms of QE being unwound. But what do you consider to be the big macro risks or events on the horizon that could either encourage or inhibit investment banking activity?
Well, I think you've mentioned it. I think that is the single biggest issue that's really on top of minds of most people. I think the US probably less so because the US is in the middle of a rate hike cycle. The US also is growing relatively strongly, and I think the market has begun to adjust to higher rates, and from that perspective, the US is more a matter of just continuing along that process. I think Europe is much more interesting in that context in as much as QE obviously, or the end of QE hasn't happened yet. Rates haven't started to rise, so when that does, I think that'll be very interesting, both because it's the beginning of a different cycle, because growth is lower, and as a result, we'll have to see how economies adjust to that, and of course, how some of the other macro factors around the world are going to influence that. But I think financial markets are very much preoccupied with monetary policy at the moment.
Banks have been working through a swathe of post-crisis regulations for coming on 8 years now. Does it feel like we're coming towards the end of this period of regulatory tightening, or will it be a case of there being more of a focus on different types of reforms?
I think the process of new regulations, new rules, new restrictions on activities of banks has definitely slowed. And so from that perspective, that's a good thing. On the other hand, I don't foresee the existing regulations, the regulations that have come into force since the financial crisis, really disappearing anytime soon. So I don't think the burden is going to somehow magically reduce or disappear. I think some of the optimism that markets had after the Trump win last year was perhaps a little bit misplaced, because the rules in general, I think, are going to stay in place. But let's hope that the pace of new rules has slowed down, and I think that's probably accurate.
There's obviously been sort of more prominent protectionist policies, or at least rhetoric, coming from certain countries, namely the US, and the G20 watered down its commitment to open trade sort of earlier this year as well. Is there any correlation between this and what's happening in global banking? I mean, is it impacting banks or their clients' sort of cross-border plans or aspirations?
Not yet, to be honest. And activity this year has been very high, continues to be very high, not quite at record levels, but pretty close. So we certainly haven't seen a meaningful slowdown. Having said that, it has certainly informed the conversations with clients. That goes without saying. But to be honest, it's not just more regulation or more protectionist policies or less ability to transact across borders. It's also other factors. So, for example, the Chinese policies of restricting some outward investment have been pretty impactful, considering how important Chinese buyers have been of overseas assets in previous years. So as an example, that doesn't really have anything to do with the point you outlined, but it's a big deal in terms of deal activity. So I don't think, though, having said that, companies are still, firstly, active, secondly, have healthy balance sheets, thirdly, we're in a period of relatively low economic growth, which means that strategic activity is one way for them to find growth that maybe doesn't exist organically. And lastly, financing markets are very, very benign, favorable. Rates are still low, liquidity is high. So all those things encourage deal activity, and we're seeing that.
On IPOs in particular, it's obviously been a sluggish few years globally, although, as I understand, things have picked up a little bit this year.
Yeah.
And there's been some speculation about whether the IP model is broken. Do companies just not want to go public anymore? What's your view?
Well, I think to some extent that's probably true, especially in the high growth space in technology and biotech and so on, primarily because there's such an abundance of very attractive private capital, so the companies don't feel the need to go public. They can refinance and grow and get liquidity for their founders from private markets. And so it doesn't mean that IPOs don't happen, they just happen later in the life cycle of companies. So I think that is true, but that's pretty limited to a certain sector and mainly US companies. Elsewhere, we are seeing that, and we are seeing a revival of activity, and I think the IPO market or the IPO model isn't really broken. I think the issue, though, is that there are many competing forms of capital. Public market is one of them, but private equity firms have a record amount of capital. Leverage, as we've talked about, is abundant and cheap. And as a result, companies can find many ways of raising capital, and IPO markets is just one avenue. So I would say it's more competition as opposed to a broken model.
Christian, thank you very much for your time.
Thank you.